Hello, everyone, and thank you for joining us today on the Dairy Signal. We are going to be diving into maybe a little bit of a hot topic, one you've probably heard a little bit about, maybe have a little bit overwhelmed hearing about, and that is the One Big Beautiful Bill Act here. And what does that mean when it comes to dairy and the products that we produce? But before we dive into that here this morning, I just want to say I hope you are staying warm. If you are anywhere in the Midwest, it is a cold one out there, and we are just
Mm.
keeping you in our warm thoughts as you go out and about during your daily chores and activities here. So, whatever you need in terms of warm thoughts and feelings, we're sending them to you guys out there. But with all that being said, I know we've got a really great conversation coming at you here this afternoon. And joining us today is Kevin Block, who is a CPA and partner with MBE CPAs. So, Kevin, we're excited to have you come on and kind of break down this almost overwhelming and a little bit challenging to understand some days discussion about the One Big Beautiful Bill Act. So excited to have you on. But let's just hear, if you wouldn't mind, a little bit about yourself.
Yeah, thanks for having me. As you said, I'm Kevin Block. I am a partner out of Sun Prairie, Wisconsin, with MBE CPAs. I pretty much lead our national agricultural practice, so that's where my specialty is. And I've been in the public accounting world for about, I would say, 14 years, 14 really good years, interacting with primarily business clients in a variety of industries. But my focus is agriculture. And yeah, I enjoy it. I enjoy the industry. I enjoy the hardworking folks out there. And so I really do appreciate being here so I can take part in educating the producers and doing my part.
Well, we're glad to have you on and your expertise here this afternoon. And I do have to say, for folks who maybe are staying in warm or whether in their tractor cabs or wherever else they may be, that if you're watching live, you can ask your questions to Kevin. And to ask your questions, it's really pretty simple. All you have to do is move over to your video screen, excuse me, and you head to that bottom right-hand corner, and you're going to see three dots. On those three dots, you click it, and there is a prompt that says ask a question. And from there, you can fill out the information and ask your question. It does ask for a name. You can honestly put in anonymous or NA or leave it blank if you don't want to, but it does ask for that prompt. But whatever the case is, we hope that you join us here this afternoon and participating or engaging with some questions if you have any. With all of that being said, Kevin, I know we've got a lot of great information to get to, so I'm going to turn it over to you to get us started here this afternoon.
Yeah, appreciate it. Thanks, Amber. So let's go ahead and get into it. I already talked a little bit about myself. There's kind of our specialty areas. And just a little bit about MBE CPAs. We have a variety of locations throughout Wisconsin. Again, I'm out of Sun Prairie, so I'm dealing with the freezing temperatures as well. We do have offices in Nebraska, Colorado, Arizona. And so we are a national firm. We do a variety of niche areas as well in agribusiness, ideology, construction, manufacturing, real estate, and hospitality. We are a top 300 firm as of 2025, and we are also aligned with the BDO Alliance. And something that makes us really unique in our servicing of clients is we do have a lot of sister companies that we aren't just a public accounting firm providing the traditional accounting, tax, attest services, and advising. We also have a payroll company, a wealth company. We have a marketing company as well and a real estate management company. So we can kind of tackle different angles and really be a good resource for many of our clients. So that being said, let's get into it. I think the One Big Beautiful Bill, it was pretty much passed in July of 2025. There's just so much in the One Big Beautiful Bill. I just kind of tried to pull out various updates that probably apply to businesses as well as individuals. I did pull out some of the stuff that will affect the agricultural industry as well as the dairy producers. And so there is a lot. And if you do have questions, like Amber said, feel free to go ahead and post those questions. We can address them right when you have the thought so you don't lose it. And we'll get right into it here. So accelerated depreciation, that's one of the bigger changes. Section 179 is an accelerated way to deduct your equipment. And Section 179, it was around, but it was like 1.2 million. Some of the larger producers may have been butting up against that threshold. And so they ended up increasing that expense limit to 2.5 million. So it was 1.2 in 24. For 25, it's increased to 2.5. And then the phase out is now 4 million. So if you buy assets over 4 million in the year, then the amount of Section 179 that you could take would be limited. The phase out would start. And so the purchasing limit was 3 million, and they increased that to 4 million. So again, it's all good stuff for producers. You're able to take deductions for equipment. You're able to deduct things as you purchase it or as you place it in service versus depreciating it over their useful lives. And Section 168 is also known as bonus depreciation, which bonus depreciation, it was kind of phased out over the last few years. And as part of the Tax Cuts and Jobs Act, bonus depreciation was supposed to be kind of phased out till you can basically not have it anymore. And what the One Big Beautiful Bill Act did, or OBA we can call it, what OBA did was it restored it permanently at 100%. So that's going to help a lot of producers really deduct or accelerate depreciation related to single purpose agricultural buildings. Really any asset that has a useful life of 20 years or less, we can take 100% bonus depreciation. A little bit of a caveat here for 2025. It's basically any assets that were acquired after January 19th, 2025 and forward. And anything, if you happen to place an asset in service January 1 to January 19th this year, it would fall under the old bonus depreciation rules. That was just because when President Trump was the inauguration date essentially was the reason why that there's a little bit of a difference there, the caveat there. So again, bonus depreciation, a really good tool to use. For Wisconsin, bonus is still not allowed, so you're gonna continue to have a Wisconsin adjustment. And bonus, again, you can actually use that to create a loss and create a net loss, whereas Section 179, you can't use that to create a loss. Usually 179 will get you to zero. It'll get you to break even, but you can't use that to create a loss. Section 168 you can, and it's back and it's permanent. And again, it's 100% of the cost of the assets when you place it in service. So that's a big change with regard to accelerating your deductions for the year that you're placing those in service. Another thing that they brought back and pretty much made permanent as well was the qualified business income deduction. That is related to I always call it like a 20% haircut. So basically, if you're a qualified business, you're allowed to take your net income, multiply it by 20%, and that's essentially going to be equal to a deduction. There are still some hurdles that you have to kind of overcome with regard to wages, and usually it's limited to 50% of your wages that you pay to employees. And then there's like a 2.5% of your assets limitation as well, or hurdle. But that's something that is awesome for producers. You get that qualified business income deduction. It's made permanent. Previously, it was part of the Tax Cuts and Jobs Act, and basically it was going to go away unless OBA did something. And here we are. QBI is here, and it's here to stay. And it's equal to that 20% of your qualified business income. It's really great deduction. A lot of folks that are working with cooperatives, they also will continue to have essentially the QBI that's going to be passed through from the cooperatives. So it's Section 199 Cap A. That's also made permanent. So basically, you're able to pass through that deduction. It used to be back in the day the Domestic Productions Activities Deduction. They called it the DPAD. So cooperatives are still allowed to. This is the QBI. It's very similar to what DPAD was, but cooperatives are allowed to pass through the Section 199 Cap A deduction to the patrons as well. So that is made permanent. Previously, if OBA did not expand that, that was going to also expire, but that is made permanent as part of OBA. So those are two major changes there. Continuing on, there's the business interest deduction limitation. This is where if you're heavily leveraged and you pay a lot in interest expenses, then the amount of interest that you can deduct could be limited. That's only going to apply to higher taxpayers. So if your gross revenue, your average gross revenue over the last 3 years was over 31 million for 2025, then this limitation cap is applied. So for the larger producers, your business interest deduction is potentially limited, and it was that way as part of the Tax Cuts and Jobs Act. The difference here, what OBA changed, was it basically said it was 30% of your adjusted taxable income. Well, for 2024, your adjusted taxable income was basically net of depreciation, amortization, and depletion. So you have a lower adjusted taxable income number, which the lower your number is, the higher that interest is actually limited. So you are pretty much, your interest that's disallowed is going to be carried over, but they're going to limit how much you can deduct in interest. I don't want to get too deep into this, but for 2025, as part of OBA, they're allowing you to add back depreciation as part of your adjusted taxable income calc. So the higher the number, the lower the limitation on your interest. So that'll help you out quite a bit as well. And that is a permanent change for what OBA did for you. And then for those that may have gotten the R&D tax credit, the research and development tax credit, you basically are allowed to expense your research and experimental costs. Before, you had to capitalize that over 15 years, and now you're able to expense those. Or I believe some of it was over 15 years. For the most part, it was over 5 years. You'd have to capitalize. But now, as part of OBA, you can go ahead and expense those research and experimental costs. There's an increased standard deduction. So they did increase the standard deduction, and they made that permanent, where they were able to index the deductions going forward. So that'll be really nice as, potential inflation adjustments happen over the years. Your deductions are also going to continue to kind of go with the flow and increase your deductions there. Just on this slide, you can see what the standard deduction was for singles, married, or head of households, and how they compare to 2025. You're still able to get an additional standard deduction if you are 65 or older, or if you're blind, you're able to get that deduction as well. So the standard deduction, again, it's you either take the higher of the standard deduction or the itemized deductions on your tax return. And so the standard deductions previously, if it wasn't for the Tax Cuts and Jobs Act, the standard deductions would be almost cut in half. And so you'd have a lot more folks itemizing their deductions. And that's what it used to be. You used to have a lot more folks itemizing their deductions to kind of increase their deductions. But with the Tax Cuts and Jobs Act, they doubled the standard deduction essentially, which made a lot of folks not have to itemize their deductions. That actually simplified filing their tax return. And OBA ended up just kind of expanding that and making it permanent. So we had the higher kind of doubled standard deduction going forward. So that's beneficial for the taxpayers, just kind of in general too, but even, obviously for our producers. Something that's new for 2025 through 2028 is this senior deduction. So this deduction is in addition to your standard deduction. So, and it also doesn't matter if you take the standard deduction or if you itemize your deductions on your personal return, you will get the senior deduction, and that's going to be for seniors or taxpayers that are 65 or older. And you would get the additional deduction for $6,000 for the taxpayer. And if you're married, you'd get an additional $6,000. So in total, if you're married and you file a joint return, you'd be able to get a $12,000 additional deduction for 2025 through 2028. So it's a huge huge savings. Um, it's one of those things where, again, it doesn't matter if you itemize or you take the standard. It's just an additional deduction, and it's in total up to $12,000. It's going to benefit the taxpayers that have a lower income thresholds. So if your adjusted gross income is above the threshold, then the amount that you're going to be able to deduct would potentially phase out. It would be lower than the 6,000. So if your adjusted gross income, if you're single, is over 75,000, then that $6,000 could be limited. And if you're married filing jointly, if it's over 150,000, then the amount that you can deduct there is limited as well. It would potentially go down to zero, depending on how high your income is there. There is also a above the line deduction. This is going to be after 2025. It isn't related to 2025 itself, but after 2025, so it's not going to affect your taxes this year when we do 25's return. You could get a $1,000 charitable contribution deduction where, again, you don't have to itemize to claim this, but the charity contribution that you do has to exceed 0.5% of your AGI for it to be deductible. So something to think about if you were, when I was planning with a lot of my clients this year, we were deciding whether or not we wanted to contribute to charitable organizations in 25 or 26. So I had a lot of great conversations in the off season consulting my clients on that when we were doing tax planning for them. So itemized deductions, that's also a huge change. If for those folks that were filing their returns and itemizing their deductions, there's a section when you itemize, there's the medical section, then there's the state and local income tax section, then there's the mortgage interest section, and then there's like this miscellaneous section. For the tax section, as part of the Tax Cuts and Jobs Act, it limited how much you can deduct in that specific section to $10,000. And so this is where you would deduct real estate taxes, state income taxes, sales taxes, all of that would be aggregated up. And if it exceeded $10,000, well, then you'd be limited to $10,000 on that section there. What OBA did was it actually increased that from 10,000 to 40,000. And that's great for the taxpayer because now we can deduct more of our taxes that were paid during the year. We can deduct more of that versus being limited by the 10,000. So potentially, if you were limited in the past by that $10,000, you might be able to actually itemize again. Of course, if the itemized deductions exceed your standard deduction. So anybody that has modified AGI over the threshold limits could see that deduction, that cap, go back down to $10,000. And so you kind of have to do a calculation to verify whether or not you get the full 40,000. But for most taxpayers under that threshold, you'll be able to claim the up to $40,000 in the state and local tax section of your itemized deductions. So that's going to be extended for 2005 to 2029. It's, again, another opportunity to reduce your taxable income by increasing your deductions. I've talked with a lot of my clients that have pass-through entities like S-corps and partnerships. If their income was high enough, we would probably make the Wisconsin entity level tax election, where we would be able to get a federal deduction for taxes paid at the entity level. So there's ways to get around this limitation that I've consulted with a lot of my clients on. It saved them thousands of dollars in federal income tax. So there are ways around this, but it does help that they increase this limit because maybe we don't have to do the entity level election. Marginal tax rates are increased as well. So they increased the marginal tax rates. They actually kept the tax brackets the same as part of the Tax Cuts and Jobs Act. If OBA did not do that, the rates would actually be 15%, 28%, 31%, 36%, and then at the highest level, 39.6% for your individual taxpayers. Well, with OBA actually kept the tax brackets as part of the Tax Cuts and Jobs Act. And so we get to keep the 10%, the 12%, the 22%, the 24%, 32%, 35%, and the highest is 37%. So that is still around, which is great. And then they also increased the the bracket itself to like basically have more taxable income in those brackets. So what does that mean to the producer? It means it's less taxable income, which means less taxes. And these changes were actually made permanent as well. So they're not, they're basically not, there's no expiration date there. It's made permanent, and these brackets are also adjusted for inflation too. So they will be increased every year annually.
So, Kevin, before we continue talking about tax rates, I'm gonna go back a second, I guess. This question came through right as we were starting this next section, but it is in regard to the deductions that we were just talking about. And this one reads, with so many deduction changes, what is likely the biggest area of impact for general producers? That's a hard question.
Yeah, I mean, the biggest impact there is if producers are looking to replace their equipment or replace maybe the dairy facilities, the dairy barns, the parlors. Maybe they're looking for expansion opportunities. Uh, this is the time to really do it. This is kind of where we're going to have the opportunity to potentially take a good chunk of the investment, and realize the deductions a lot sooner. We could either take it through Section 179 or bonus depreciation, and instead of depreciating any assets over 10 years, 15 or 20 years, we could potentially take that now. And so that's kind of an opportunity there where we're going to really reduce taxable income, and we'll be able to recognize the investment a lot sooner instead of having to wait over 10 or 15 or 20 years. And that's helpful. I've got some clients that I've been consulting with that they're looking at expansions, they're looking at adding more parlors. And so I've been consulting with them on the opportunity there to say, okay, well, instead of prepaying, when we're talking about tax planning, instead of prepaying for certain things, we're able to say, oh, you know what? I'm actually planning on doing a parlor facility in 2026. And then maybe a few years later after that, in 2028, I'm going to do another one, and just kind of plan out when these investments are going to happen, and really figure out when you want to time your other deductions to make sure that we're planning for multiple years, not just 1 year. So it's just if anything, it's a really great opportunity to reduce your taxable income and really invest. If you're looking to replace old equipment, old buildings, or expand, it's really a good opportunity right now in the next few years to do it.
Well, I appreciate you putting that in plain language of, these are the things to be thinking about because they can have a lot of, potential impact on the bottom line at the end of the day. So I will
Hmm.
let you keep going on here with talking about the tax rates, but appreciate the question that came in from a listener,
Yeah,
and we'll keep going for now.
yeah, appreciate that. So we have the single margin brackets. I just wanted to show you married filing jointly. You can kind of see that those are changed a little bit as well. Again, it's made permanent and it's updated for inflation every year. So those numbers will continue to go up. Some of the other changes that you're going to hear, you've probably heard about. I'm just going to touch on it. I don't know that it affects dairy producers all that much, but you've got the no tax on tips, and that is basically all three of these provisions are from 2025 to 2028. So folks can claim a deduction up to $25,000 on qualified tips. There is a phase out there. No tax on overtime that generally applies to those that are not exempt from basically the overtime rules. And so they get a deduction of 12,500 for single, or if they're married, 25,000. And no tax on car loan interest. So this is really going to apply to personal vehicles that are purchased. It's not business related, but it's personal, and it's related to vehicles that are assembled in the U.S. And they're basically limited to a deduction of like $10,000 per year. And there is a phase out there as well, but you basically can claim a deduction for your interest from 2025 to 2028. It's just another opportunity. Historically, you never were able to deduct personal loan interest for vehicles, and this is actually an opportunity for you to do so. Some of the other changes, the child tax credit. So they expanded this one. Again, this one's actually indexed for inflation, which is really good. for many of our producers that have children, and it is made permanent. So in 2024, the credit was equal to $2,000 per child. That amount of obviously increased as part of the pandemic, and so COVID relief increased those numbers substantially, but it went back down to $2,000. And OBA ended up increasing that to 2,200 and adjusted it for inflation, and they made it permanent. So it's really really good news for the producer, especially if they have a lot of children. And then something to think about with the lifetime exemption limit. Anybody that was worried about the um, lifetime exemption limit, if they were worried about estate taxes and planning for trusts and stuff, you should always succession plan. That's something that we're always talking to our clients about is succession planning. But also with the lifetime exemption limit, they increased that to 15 million after 2025. So that's per taxpayer. So if you're married, that's 30 million. If your estate is less than that, then you don't have to worry about the estate taxes there. And that number is adjusted for inflation, and it's going to continue to go up. It's made permanent. It's just a really good opportunity for our producers there. It's always good to plan, what's going to happen with your assets after. And the lifetime exemption limit really helps for our producers so that we don't have to necessarily worry about establishing all these complex trusts and protecting the assets. For the lower valued estates, it's really a good opportunity to not necessarily have to worry about estate taxes and potentially losing half of your farm, for example. So really good news for producers. This is a little bit hyper specific for our producers that have farmland that they're looking to sell. And basically, usually farmland, you get the capital gains tax treatment, which is awesome. You get the capital gains tax treatment. It's taxed at 0, 15, or 20% for federal tax purposes. And then Wisconsin, you get that 30% deduction plus the additional 30%. So you get 60%. And then if you sell it to a related party, it's 100%. This is a little bit different with what OBA did was they said, hey, if you have farmland that you've used in the previous 10 years, you've used it as farm, you either farmed it or you're leasing it to a qualified farmer. So that's the previous 10 years. If you sold land and you have a capital gain and you previously used that land for farming purposes, they actually say we'll calculate the taxes on that sale. And we will say, okay, in the past, you had to pay taxes right away. So if you sold it in 2025, that farmland, you're going to have to pay taxes on the 2025 return. So then you'd have to pay taxes by April 15th, 2026. Well, what OBA did was that they said if the sale happened after July 4th, 2025, they're going to give you the option to basically pay the tax in installments. So they're not allowing you to recalculate the actual tax related to the sale, but they're going to say whatever the tax is, you can pay it in 4 equal installments, and those are annual installments that are due on the annual tax due dates. So, for example, the first installment would be due April 15th, 2026, and then the next installment, April 15th, 2027, and so on. So it actually gives you the opportunity to defer taxes without incurring interest and penalties. And it really does help with cash flow, so you can kind of not necessarily have to pay the related taxes on that sale right away. So that's really good. The covenant here, though, when you do sell that property, it does have to be sold to another qualified farmer that is essentially going to have to use that same farmland for farming purposes for 10 years. So it actually restricts the use of that farm for 10 years. It's not a big deal for our producers that are going to continue to farm. But it's just another opportunity for our producers to really just defer taxes and not have to necessarily worry about paying the tax right away. So it's just a new thing. I'm not sure how popular that's going to be because there's other opportunities to defer taxes through like a like-kind exchange that's still around for real estate. Wisconsin, you're not really paying too much in taxes. So that really this is going to help for federal tax purposes there.
Well, it brings up an interesting question, though, Kevin, that especially since, and correct me if I'm wrong, you're saying that whoever that land goes to, that next 10 years has to be in farmland for this to be eligible. How is that enforceable? Just so the folks who are out there, maybe they're like,
Yeah.
I've got a really great person who's in my family, but you never know what happens in 10 years.
Yeah, usually they either have a covenant on the property itself as part of the sale or some sort of legally binding document that restricts the use of the land to agricultural purposes or farming purposes. That's how you're supposed to document it and qualify for this treatment. And I think as far as it being enforceable, it's always up to the IRS and their agents to potentially audit you and take a look at it and say, hey, do you qualify for that or not? Uh, it's sticky. I would say if there is no covenant and a taxpayer or producer wants to treat this as installment and they're just going to pay it in installments and they don't actually qualify because they don't have the covenant, that's where the IRS could say, nope. After they look at you and potentially audit you, that's when they're going to be able to say, okay, where's the covenant on this property? Where's the restriction there? If you can't produce it, then they're going to disallow it, which is a huge problem. And then they're actually going to say, well, actually, the taxes are due in the year that it was sold, and so all the taxes are due then. Of course, then they're going to turn on the penalties and interest, and then the producer has to pay that. So it's very important that if you want to qualify for this treatment, this installment sale treatment on the taxes, make sure you're following the rules. Talk to us, talk to your accountant, and make sure that you're following the rules properly so that the IRS doesn't bite you in the back. So,
This is
yep,
definitely one where it sounds like you want to have all your ducks in a row
yep,
going forward if this is the route people so choose. But that's good to know to have that up
yep.
front and be this is an option, but know what you're
Hmm.
getting into.
Definitely. Yeah, great question. This is basically for sales after. It's so goofy some of these dates as part of OBA, but after sales that occur after July 4th, which is when OBA was signed into law. So any if the sale happened to be before that date in 2025, well then you wouldn't qualify for this treatment. But if it happened to happen after that, then you would qualify. So just kind of want to point that one out.
Well, thank you. I'll let you keep going on here. I know we'll have, oh, yes, I know we'll have more questions on this subject for sure.
Yeah, yep, definitely. So the I think OBA ended up changing the dairy margin coverage as well, which is, obviously that safety net for our producers. And a lot of good things that happened. Obviously, we're still waiting for a farm bill, but OBA kind of helped out a little bit ahead of that. Hopefully, we get a farm bill, a new one, maybe this year. I don't know. If we don't get it next year, hopefully next, or if we don't get it this year, hopefully next year. But the dairy margin coverage was actually extended through 2031. So that is again really big. This is that financial assistance you get monthly where your margins fall below the covered chosen level that you're insured for there. And so what they ended up doing with this program was they ended up increasing the tier one coverage to from 5 million pounds of milk to 6 million. So more of our producers are going to be able to have more of their production covered, which is huge. And they did allow you still have multiple years of a discount that you can qualify for. So really, you could insure your production for 6 years and qualify for a discount of 25%, which again is going to be huge for our producers. And one of the biggest things that they changed was the baseline of our milk production. So before it was based off of I think 2013 to 2015. Now they've allowed us to base our production history off of the highest year between 2021 and 2023. And then we can kind of recalculate that every 5 years. So again, it's going to be huge. We're able to cover more of our production. We're able to use more historical rates that are probably closer to your actual production. And so it's just going to give our producers a lot more opportunity to have that safety net and have more of a margin payout, whereas before you might not have had that payout. So that's a huge change there. Again, it's really to help with low margin periods. It's going to help us with cash flow. It's going to help us with income stability and really good stuff there. So,
So I think this is one of the biggest areas that folks are probably perking their ears on because DMC
mhm.
coverage, it's just been one of those areas where there's been a lot of discussion and talk about, but in a lot of good ways, having this as an
Yeah.
option for folks. Um, When thinking about enrollment and all of that good stuff, having a 25% multi-year discount is really a great option
Hmm.
for a lot of folks. You know, it sounds silly to say for folks who are on the edge of like, is this an option for me? I feel like this is a really pushing more folks towards it because it's not 100% enrollment, which is in some ways surprising. But
Hmm.
if you were to talk to a dairy farm that hadn't had DMC coverage before, what is your one sticking point within these changes that, gosh, this can make a big difference?
Yeah, I mean, I would say the premiums, you get the discount, right? And if you haven't had it before, I mean, you may have been struggling when your margins were lower and you didn't have a payout. And so this is just with the lower premiums and the kind of locking it in for, up to 6 years if you wanted to, it just gives you more protection. It gives you more it gives you that safety protection. It helps you plan and risk, manage your risk. And again, you can cover your more of your production. It's just something where historically, if you didn't have it, you should definitely look into it. And if you did have it and you weren't getting your payouts, you might be more likely to get a payout just because you're able to cover more of your production. And we're increasing your history, the baseline there where you're able to cover more of your production as well. So it's just again, you're increasing the amount of production and how much of that could be covered in this program. That's just going to help all of our producers out with getting the payouts, whereas in the past they may not have gotten it just because, I mean, historically the baseline was so low that maybe it wasn't covering a lot of your production because the limitation was so low. It was based on a years ago, 2013, 2015, whereas now it's like, okay, it's going to match a little bit closer to what you are actually producing, and so it's going to be helpful for a lot of our producers there.
Well, and one of those questions for you, kind of combining a little bit of a discussion earlier of, if you're one of those farms that's in the phase of expansion, maybe you're taking some
Mhm.
options of those deductions or availability there, and you're in that expansion phase, maybe in the next few years, and it allows recalculation every 5 years. Are you somebody who would say, even if you're locking in coverage for the foreseeable future, are you able to change within that 5 year period if you keep the current coverage you have now, and then recalculate then, or do you have to wait to lock in for the remaining years until you recalculate?
Yeah, I mean, I actually don't really know the answer to that
Fair
question.
enough.
I think it's a great question. You can obviously connect with the USDA and see what they could cover. They have a great website and great resources to reach out to. Yeah, I'm not entirely sure the answer to that.
No, and that's fair.
Mhm.
Appreciate your being honest with that one. Just figured it was a question to ask because if
Yeah.
now is the time and you are available to look forward and maybe expansion is part of the future, what does that look like when it also comes to DMC? But great to
Mhm.
know. Just talk to your FSA and USDA, those folks. So with that, I'll let you keep going on because I know we've got some other good stuff here.
Yeah, yeah, and I can certainly get back to you on the answer to that as well. I don't think it'll be too difficult to get that. So some of this other stuff I kind of want to touch on. I wouldn't say it directly impacts our dairy producers, but it's just some of these additional programs that were expanded. The One Big Beautiful Bill got rid of some of these conservation and environmental programs, and then it added some and extended some. So I'm just going to kind of at a high level touch on these. So the Environmental Quality Incentives Program, they increased the funding for this from 2 billion to 3.2 billion. So they increased it by 1.2 billion. And these are for any producers that are looking to improve water and air quality, conserved ground and surface water, increase soil health, reduce soil erosion, improved and created wildlife habitat. So you can kind of see all the things that you could qualify for. This is more hyper focused for the producer. If you have an issue that you wanted to specifically address on your farm, this is just a good opportunity for you to just look at the program. The funding is there, and it's pretty much going to be there through 2031. So if you were questioning whether or not a program like this is if it's going to have funding, well, it will have funding. So you can kind of take a look at those programs, connect with the NRCS, and look to see if these programs would benefit you. And again, you have 6 years there, 25 to 2031 here to take a peek and see if you qualify for any of these funds. So that's another great opportunity there. They did extend and increase the funding as well for CSP. That's the Conservation Stewardship Program. This is the program where they're looking at the farm as a whole, and they're already looking at what the farmer's already doing with regard to conservation and environmental, and they are kind of expanding that. Like, what else can the producer do to kind of help with conservation efforts and help with the farm to improve quality, so that they don't have to invest in a lot of other different things. So they expanded it through 2031. They increased the funding here by 400 million. And again, these contracts are about 5 years. It's just a great opportunity to just look at those conservation requirements that maybe you haven't been looking at, or maybe you didn't qualify for, because they did expand it. And you should look at these programs again just to see if you do qualify now that they've increased eligibility, they've increased the funding. It's just a great opportunity to take a peek at that as well. And then the Agricultural Conservation Easement Program, it's really there to protect the land from, to keep farmland, and to keep wetlands. And so again, it's just a way for our producers to protect the use of their land. So that is expanded through 2031. Again, it's a great program there to kind of protect the land for what you intend it to be used for. So having it in an easement, it's a good opportunity there for our producers, and really you can rely on that program to be around through 2031. There's some other programs too that I'll just kind of highlight. Grassroots source water protection, so safeguards the well water. There's the Voluntary Public Access and Habitat Incentive Program. It's going to reward our producers for opening land for hunting and recreation. And then there's the Feral Swine Eradication and Control Pilot Program. It's going to kind of use to combat invasive wild pigs. And so again, just kind of looking at how it affects our producers, our agribusinesses. It's, these conservation programs, it's just going to help you long-term plan your conservation efforts. It's going to help with, you making those investments. Maybe you want to go into a different market. It might help you with market expansion opportunities. And then it helps with risk reduction, helping with healthier soil, for example. It's really protecting the producer from maybe diseases as well, and protecting the water on the farm. And, it's just something that you should look into. If you didn't qualify for it, maybe you should look into it again, or maybe you weren't aware of it, and you should take a peek and see if there's funding for you. And maybe there's a pain point that you never really addressed on your farm. And so there's programs out there. You should take advantage of it. And something else I wanted to kind of highlight too, they've increased the farm commodity program. So that's really for our grain producers. And so they actually increased the statutory reference prices. And so again, I just want to be quick on this one, but let me just go through. Here's kind of a good summary of what they've done for the farm commodity programs. And they increased the reference prices by 10 to 12%, depending on the grain. And the average is about 15% of what they did to increase that. And for 2025, you're going to get the payout of the higher of ARC or PLC. And that's going to be paid out in October of 2026. There was a payment limitation of 125,000. They increased that to 155,000 for 2025. And after 2026, I believe they've adjusted it for inflation every year. So that payment limitation is going to increase every year. And the entity attribution rules for our pass-through farmers, if you have your entity structured as an S corp or a partnership, historically those pass-throughs were limited to the $125,000, just the payment limit. After 2025, so in 2026, they've expanded it to managing members. So if you have multiple managing members, you could potentially get a higher payment limitation, and you won't be limited based on just the entity, which is, again, huge. And then Historically, we've had to use the base acres with the historical allocation. They've actually increased that. And so they've actually increased the historical acres, I believe 30 million across the board. And so that's going to obviously help with increasing these program payments for PLC and ARC. Again, this is kind of more for grain producers. If you have grain held in storage, they're going to increase your loan rates by 10%. So there's some stuff going on there. I guess, did we have any other questions, Amber?
We don't have any other questions from listeners, but I definitely have some questions myself in general
Sure.
when thinking about these areas.
Yeah.
But is there anything else that you wanted to comment on or put forth first?
No, I think, like I said, I just touched on this quick just because it primarily applies to our grain producers. And, I think there's just, at the end of the day, OBA ended up increasing funding, right? There's a lot that OBA did do. And so if you're not consulting with anybody, you can always reach out to us or you can consult with your CPA or accountant and really just kind of do a deeper dive and figure out how OBA is going to affect you. I had a lot of conversations with clients in the off season. I would say from, October to the end of the year, I had a ton of conversations with our producers and try to figure out, well, how does OBA affect them, plan for it, and figure out what the funding might look like for them. And it really, I feel like we added a ton of value to what they were trying to do. So, I think overall there's funding out there, it's available, and it's a great opportunity for producers to take a look at. If you're looking to expand in a different market, there's conservation funding that could help you with that. If you're looking to expand your dairy operation, there's going to be the accelerated depreciation deductions that are going to be available. So again, planning. And I wouldn't just plan for 1 year. I want you to plan for multiple years, especially because we know a lot of this is going to be good through 2028. A lot of the conservation programs, some of these other commodity programs are going to be around until 2031. So we have a little bit of stability. I mean, we're still obviously waiting for the farm bill to have more stability and feel a lot better about it. But OBA did help a bit. And so that's kind of one thing where there's still planning opportunities. There's still great opportunities to have some good dialogue with your accountants and just kind of work with them on analyzing what your funding might look like, your safety net might look like, insurance opportunities, your coverage levels. There's just a lot that you can do, and it's just a lot more opportunity for our producers.
So, Kevin, when thinking about some of that planning, though, this really leads into some of the good questions I was thinking about and ruminating on here at the end is, when thinking about a lot of opportunities, especially when you mention, like, if you're somebody who's looking to expand, great, you're going to be able to take advantage of some of those opportunities there. But right now, I'm also thinking about a lot of those producers who are looking at that milk price and go, well,
Mhm.
we thought that might be in the cards, but that's not going to be happening here, at least in the next few years, just given
Yep.
where we're at economically. So, for folks who might not be able to be in that expansion phase or are maybe just trying to think about how they're going to be able to make it through the next year, let alone what's going on, what are some of these areas that I mean, we have DMC, which is a great
Mhm.
option for some of those areas in which producers can take advantage of and really be thinking about how that's going to help on their risk management side. But when it comes to tax deductions and thinking about, well, gosh, maybe some of these things we had planned aren't going to work out like we thought. But what other options are for those folks who are just trying to make it through? What are some things to be thinking of?
Yeah, there's so many different opportunities. It's such a great question. I mean, it can get hyper specific for taxpayers. It really can. And that's the beauty of it. I love it. It just talking with my clients, even in low income years, there's plenty of opportunity. Like for example, I've got clients that have a lot of funds in some sort of like retirement accounts. There's opportunity to convert those over in low income years. And so I think I was able to convert probably $500,000 of pre-tax retirement funds over to after tax, and I only max out the 12% bracket. So there's some really good opportunities that you need to think about even in low income years. And so Obviously when you're penny pinching, you're hoping for these program payments to come out. Obviously, we all want a fair milk price. We all want to get the funding there and make a livable wage and grow and have a higher milk price even. But there's just opportunity there, even with the low milk prices and kind of where you're able to just take advantage of the tax laws that are out there. It's just really having a good dialogue with your CPA and figuring out, hey, this year isn't looking too good either. What can we still do? There's still opportunities to plan when the price is low. And there's even insurance coverage opportunities as well that you need to look into as part of OBA that can help you with from a coverage standpoint and help you with that too. So
Well, and I think that's a really great point that you brought up is that you don't have to go to your CPA only when times are going great in terms of here's
mhm.
what I want to do and think about. But, these are the conversations that can be had, like you said, in that last quarter of the year for planning and preparing for the next one. A lot of the times those conversations can be really helpful. I know now is typically a more busy season, or at least the start of really diving into things. So when do
Mhm.
you recommend that folks, when they're thinking about their business and they're thinking about what's going on, when do you recommend that they really bring in their CPA for some of these conversations when they're planning, trying to think about what's going on, whether that be, good years or bad years?
Yeah, it's a good question. I would say for the most part, when folks usually bring me in is probably now, like at the beginning of the year. They're always looking for coverage and making sure that they understand what that is. If they need assistance, we're always happy to help with that. Planning season, we could plan any time of the year, but most of my clients will start it probably in, I would say, as early as September, but most in October, November, and December. That's usually when I have the most conversations. If you're worried about anything or if you have questions or expansion opportunities, reach out. That's there's there's an opportunity, and trust me, if you don't reach out and you miss out on an opportunity, it could cost you way more money. So your CPA should be there to assist you. They're part of your team. And if you don't involve a member of your team in some of these opportunities, or even again, if you're struggling with cash flow and you need someone to help you look at that and look at margins and figure out, well, where can we help? There's always obviously consultants out there that's part of your team, but you should also include your CPA because tax comes into play as well. And they're well versed, such as myself, we're well versed in these opportunities that you might not be aware of, or you might not be aware of the changes that were part of the like OBA, for example. So a lot of things change year over year. There's planning opportunities in low income years or high income years, and so just involve early and often. I would say they'll be able to tell you whether or not they're going to be able to add value. I'll excuse myself if I know right away I'm not going to be able to add value into a conversation. But most of the time, there's opportunities for us to jump in and help out.
Well, and I think you bring up a really good point that, within right now with this, next year, and especially with the when OBA came into place this last year, there's a lot of nuance into what's going on from what you might have, I don't want to say typically gone through here, for folks when they're going with each year's tax planning. But it brings up a really good discussion of this is only scratching the surface of
Mhm.
what's happened in OBA in this last year here. So having somebody who knows what's going on and can dive in deeper into each specific situation, like yourself, is incredibly valuable. So
Mhm.
appreciate you talking about that. Before I let you go, got a couple more questions. When
Mhm.
thinking about 2028 and 2031 with some of these, I don't want to say deadlines, they're not really deadlines, but when some of these areas are going through effect until, what are some of the biggest ones that you think are going to have advantages for producers? I know we've talked about quite a few of them. I know we've gone into depth a little bit more on some of them, but are there any ones where you're like, if I was a producer and I needed to look at something, this is what it would be?
Yeah, I mean it all stems from their goals. Like what are their goals as a producer, right? And it kind of depends on where they're at with their business cycle as well. But I would say, of course, you're always worried about cash flow. You're always worried about margins. And so making sure that you're covered, that's the biggest thing. I'm always worried about our producers and figuring out, well, what's the cash flow look like, making sure they have adequate margins, making sure they have a good safety net, making sure that they're properly insured. And like those are the big ones I would say. And taking advantage of some of these programs. Obviously, we went through a bunch of there's just so much. Like you said, we're just touching the surface of it. It really does depend on your goals and kind of what you want to do. And there's just, again, there's opportunities because of increased deductions. There's opportunities because of increased funding. There's opportunities because of these programs being extended. Take advantage of the programs, learn about them, and you utilize your team. A CPA such as myself, we can help assemble the team. We can get consultants involved. We can get insurance folks involved. And so we can, of course, connect with the USDA and make sure that we understand and know what opportunities and fundings available for these types of programs. So um, it starts with dialogue. It starts with picking up the phone, making sure, like recognizing maybe in the back of your head, yeah, there's a lot of different things that happened with OBA. Maybe I should talk with my CPA versus dropping off your information. Maybe this is the year that you should talk with your CPA. We kind of know what's going to happen in the next 4 years here. Let's make sure that we plan accordingly and talk with your CPA. Again, start the dialogue, make sure that you're listening and ask your questions and communicate your goals because the CPA is going to be there to help you accomplish those goals. So,
Well, and I have to say this might be a redundant question after that because I feel like that would be like the perfect bow on this afternoon. But I'd be remiss if I didn't ask you it and give you the chance to add anything else on. But if you have one or two key takeaways that you want producers to be thinking about or actively doing after today's conversation, what would they be?
so I would say for sure, obviously everyone's looking at the DMC right now. Make sure that um, you obviously enroll. Make sure that is you have adequate coverage, planned accordingly, connect with your consultant as well, and make sure that you're covered. That's one of the big ones. There's opportunity for insurance as well. Make sure that you're covered with insurance. If you're also a grain producer, take a look at ARC and PLC and how that affects you with commodity programs. Those are some key things I would definitely look at. And yeah, I would say again, connect with your CPA. There's a lot of different changes. Those are the things I would primarily highlight and plan. Plan for accordingly. And I just want to stress it, even low income years with the low milk price, there's opportunities. And so you should always talk to your CPA because my work, I always like to optimize your tax brackets. So I already shared with you guys that the tax brackets here are 10%, 12%, 22%. Well, if we don't maximize those tax brackets, so for example, we only hit the 10% and we don't go to the 12%, 12% is not that much more. It's only 2% more. So why don't you maximize the 12% bracket? I would love for you to pay a little bit of taxes versus recognizing income in a future year where you jump into the next tax bracket. So I'm always a huge proponent to optimizing your tax brackets each year, planning accordingly. And when you do plan for the year ahead and then replan and recalibrate maybe in the middle of the year or in the fall. And then, make sure that you plan for multiple years and not just one particular year.
I have to say, I think that is a great way to end today's conversation is there's a lot going on. And when it comes to something like OBA, there is so much more than what we scratch the surface on. But
Mm-hmm.
having the right people and to go through and discuss this, having the plans in place, whether it's a good or a bad year is important. And really knowing that there are opportunities available regardless of what your situation is. It's you just have to make those phone calls to be able to figure them out. So I have to say, Kevin, thank you so much for your time here this afternoon. It's been extremely helpful and enlightening to go through some of these changes with somebody who's knows the nitty gritty of them, knows where those opportunities lie, and maybe if there's something that folks haven't thought of here or maybe planned for that might be able to bring a great nugget of wisdom and opportunity for them. So thank you so much for your time here this afternoon.
Yeah, I appreciate the opportunity. Happy to help anybody if they need assistance for sure.
And I also have to say that, as we are wrapping up here this afternoon, I have to and would not be doing my job if I didn't mention our upcoming annual business conference in March. It is March 4th and 5th this year. So it's a little bit earlier than if you traditionally have gone to our business conference, and it's in Madison, Wisconsin. And whether you are looking to plan what's going on in your business, to gain some new skills, to network with peers and industry alike, or even just to fill up your cup, that is where we want you to be here in March. Because, like today, it's about planning. And that's where the business conference gives you that opportunity. And with this year's theme of drafting your blueprint, could not fit better into that whole idea. So make sure to get registered. You can head over to our website to learn more. Give us a call here at the office. But with all of that being said, thank you for joining us here today on the Dairy Signal, and we'll see you here on Thursday. Bye now.